this.
Just a reminder, about 30 seconds now, we're going to likely hear from Costco earnings and same-store sales for the month. And we'll still on the lookout for Broadcom earnings, along with Guess and others. Costco reporting headline EPS of $3.92 a share, $58.4 billion in revenue, misses the $59.2 billion consensus estimate. An adjusted $3.62 for Costco.
Good afternoon, everybody.
Costco's net sales are up 5.7%. Same-store sales for the quarter coming in at up 5.6% for Costco. Avago, Broadcom, AVGO, adjusted EPS 284, 1099 adjusted EPS versus the 1025 consensus estimate. A revenue of 11.96 billion, that beats the 11.7 billion consensus estimate for Broadcom. They're guiding full year revenue 50 billion, including the contribution from VMware, and adjusted EBITDA guidance is 60% of projected revenue.
While technology remains the dominant force, an equal weighted version of the S&P 500 with companies like NVIDIA.
A 50 billion guidance compares to 50.1 billion consensus estimate.
That gauge is less sensitive to gains from the largest companies, giving some hope that the rally will broaden. The Treasury 2-year yields fell alongside the dollar after the Federal Reserve's Chairman Powell stated that the Fed is not far from feeling confident enough to ease policy. He stated that rate cuts can and will begin this year, while policymakers are well aware of the risks of cutting too late. The Fed chair also stated that he could see a case for shortening the maturity of the central bank holdings. So across the Atlantic,
All right, let me boom. I'm live. Thank you, Stace. So what do you got? Costco, Avgo, Marvell, right? Costco. Oh, let me get the bigger screen here. Looks like down a little bit. Was that down $1? Really? Avgo. They missed, right? Avgo or got Avgo down $45. Back to where it was not even yesterday. So I don't know what you want to do with that. What was the other one? Oh, Marvell. That's interesting too to see after this run up. And Marvell down. That's down a good $10. Marvell. Doku. Oh, MDB had numbers too. MDB is always exciting. Let's see. MDB down. Okay. And what was the other one? Oh, Doku. Is this thing, people still interested in this Doku? Isn't this like hockey stick central? This stock? Let's see. Doku's up. Go figure. Here's your hockey stick in green. My lord. What a fall from grace, huh?
You're listening to Trade the News.
All right, so looks like we might have some semi weakness in the semis tomorrow. I mean, look at this chart. I can't even what I'm looking at anymore. You know, like this is the stupid part about things right here. Like you got Avgo is down. What is it down? $20, and meanwhile, it's not even. This thing might end up green before you know it. It's not even at where it was a couple days ago. So if you want to call it a dip, you could call it a dip, I guess. All right. Anyway, I don't have too much time to yap as usual. You guys know I sit here talking shop with you guys all night long. Um, I have time. I just when I get a text from my daughter, I got to get out of here, so I can't sit forever. But let's go through some of the important stuff as usual, right? And I touched on some of it this morning. So we don't have any major changes out there, but big picture wise, we've been discussing about this melt up, and we're starting to already see that official those the ingredients of a melt up, right? I think that word gets thrown around a little too loosely. Anytime a market is strong, but we're starting to see some real signs of a melt up out there, especially in certain groups, getting more broader participation. Kind of what we were talking about. That AI theme is not just about Mag 7 and NVIDIA anymore. It's not just about the semiconductors anymore. It's a lot bigger than that, right? A lot bigger than that. We're also seeing participation from laggards. The cyclicals are starting to get attention. We'll look at some of those names. We'll talk about them in a bit. Um, so I think that the tough part about this market, and here's where people have trouble, right? If you are already in, right? Let's just talk swing trade intermediate term. Okay, we'll kind of take an average between a short term swing trader and a long term position player, right? So let's just say swing trader intermediate term. I think most of you are already aware of measures you can take, things you can do to ride out this bullish move for as long as it goes until we get some sort of correction and shakeup, right? And I'm not even talking about some top and the end or the apocalypse of it all, okay? I'm just talking about a normal correction, right? That could run anywhere from 1 to 3 months. Nice reset, cleansing, right? We spoke about that for a few weeks now, okay? So I just want to make sure everybody understands when I'm referring to the end of this move, that's what I'm referring to. I'm not referring to a all-out crash, okay? But there are measures you can take, especially via the options market these days, if you want to hold on to positions that you are already profitable on, you're letting some profits run, right? You can roll, you can put on protection. If you're in equity, you can convert that into calls to take off some of that principal risk. There are a lot of things you can do. I think where people obviously are having trouble trying to figure out how much new risk, right, you should put here without seeing a pullback. Okay. And I think that's where a lot of people are having trouble understanding because everybody assumes that everybody out there owns the same things and they're just letting things run and they got some cushion, right? If you got cushion, you can sit and wait and be patient until you see the narrative start to change. Okay. You're willing to give back a smaller piece of those profits, obviously, as long as the trend continues. Okay. But for new risk, we want to be smart about things, right? We don't want to necessarily get aggressive, get as aggressive as we've ever been throughout this move up into the highs, right? Without seeing either strong rotation into better setups or some sort of digestive period. Okay. But I think the good thing, and this is kind of what we were talking about, the good thing is, even if you want to be conservative here, meaning even if you wanted to stay a little bit more nimble, you want to be a little more tactical, right? Concerned about getting caught with a new basket of risk, right? You don't want to get caught in some correction with a new size basket of names that you just put on up at these levels, because that can leave a mark, right? That can hurt. And if not, give back a larger chunk of the profits you made in this whole move, right, in its entirety from the October lows till now, or you don't want to give back too much of that chunk. So I think what for that approach, right, because I think a lot of people don't get the answers they're looking for in regards to that. I think what you need to do is you need to be smart about things and wait for certain spots. Okay. Doesn't mean that you're not going to take losses, but it will help it can get you to avoid chasing highs and get caught in what just might be a 1-2 day shakeout and can have the same impact that a correction may have. Right. So, for example, like let's talk about ES here. Right. We haven't had many. Okay. And I think we're going to see more of them, especially if the melt up continues until we get a correction. But you're going to get these shakeouts, kind of like we saw with the CPI, where you get some news, right? Rattles, some Johnny come lately bulls, they sell, reels in some shorts, they're looking to catch a top, and you get some selling pressure for a day or two, right? That's where we want to be on the long side, rather than looking to short that, right, or get short off that. That's where we want to be looking for these windows of entries, right, on tactical, as far as tactical opportunities, whether it be intraday or whether it be short-term swings and flips and that sort of thing, right? The better the setup in that particular name. Now I'm going into names, obviously not the market, because not everything looks the same in this rally, to state the obvious. There are other spots of this market that aren't overextended. And even if you do run into some turbulence or correction, more than likely aren't going to get hit as hard as some of these names that have run 2 straight weeks and will give a little piece of that back in a day or two of a pullback, right? So that's what we've been focusing on, right? We've been talking about some of the more cyclical semiconductor names, if you guys remember. A Taiwan semi. Let's look, for example, at Taiwan semi here, right? So you had, again, not a lengthy digestion and no significant pullback of any sort, but you had opportunities here where there was a pop, kind of go dead for a little bit, right? Little shakeout, little consolidation, and then another rip, right? Another little consolidation and another little rip, right? And this is kind of where we want to focus on new entries, new risk on the long side. Okay. The longer these things get in the tooth, obviously the more risk you incur, because those pullbacks can be larger, right? Just normal price action. But the closer they are to a decent risk reward setup, the better the opportunity may be. Again, when you're looking at it through a risk perspective, right? Not just the upside. This was a name, okay? Another one. And again, this is not new. We've been talking about this. They had earnings. I think it's down off earnings. Now, again, you chase this move, right? After a rip of a week straight into whether it's earnings or not, you can get caught in a pull here and it can be pretty violent, even if it's short lived, and that can sting, right? Where, in my opinion, the smarter route to take, it doesn't guarantee that you're going to make money, but I think it's a prudent and more conservative way to try to take advantage of this rally until we get a correction, is to look for opportunities in this consolidation, especially off down days. Okay. Now, me personally, a lot of these things, even when they rip out of this consolidation, I don't have much of, right? I've been playing the equity solely, not options. I'll Some of the larger names that are going for $800 a share, obviously they don't make much sense for me playing the equity. But what I've been doing is, even when I'm buying these things off pullbacks, when I get that snapback rip, I'm taking at least a chunk of that off the table, right? Which may not make sense to a lot of you. Sometimes it doesn't make sense to me as well, considering the moves in these things. But that's just been my approach. So that's my approach here. And if we do continue to see a melt up and we continue to see new names getting involved, where I can still get involved, try to make some money, and if I'm wrong, right, I'm not going to get caught and get buried with a basket of new risk up chasing a rally for 2 weeks in names, right? So the moral of the story here is nobody knows when that one thing is going to pop up to change this narrative, right? We are looking at a few things we're going to look at in a second that possibly can tip us off to where the odds or the probability increase that we're going to get some sort of rinse in a sense, okay? But nobody knows for sure, right? That and that goes for any market. The problem is when things have run so much in a short amount of time, if and when that event does pop up, it's going to catch good amount of bulls, and there could be some aggressiveness behind that sell over the short term. Okay, so we're trying to take measures to prevent from getting nicked up. It's okay losing money. You're going to lose money in the strongest bull markets that exist out there. It's all part of the process, but avoid taking a hickey and giving back the majority of money that you may have made in this whole bull phase. Okay, so let's go. I should have started with this first, but let's get to some of the big picture signals here, so you can see what we're looking at and why there hasn't been really any warning signs on the surface. Right? Again, if there's an exogenous event or something pops up to change the narrative, that's a different story. Right? You can't handicap that. You can't plan for that. There's no way of predicting that. But on the surface, we're still not seeing what you usually see before a strong trend or chase like this starts to run out of gas. Okay. And here's been one of the reasons why. You have hedge funds, which are obviously an aggressive pocket of buying and selling in this market, right? They are chasing performance a lot of times. And again, just to make clear to everybody out there, it's not saying any particular hedge fund or hedge fund manager is dumb money. Okay, they are the sharpest minds on the street, whether you admit it or not, right? These guys know the game inside out. It's just like anything else in this market. When everybody is on one side of the fence, okay, especially when they need to chase performance, and they're managing money, it can be a problem. Okay, they have been fighting this rally throughout. Okay, the last time you could see they were short pretty aggressively into, I think this is back here. This is the October lows, right? Yeah, this is the October lows. Okay, last year's October lows. They were aggressively short into that. Then you had the Yellen pivot, the Powell pivot, right? And they remained short initially in that rally until they were forced to cover and chase to the long side. Okay. And you could see, right? You could see that he did exactly that. I'll tell you what that looks like on the chart here. So you could see that was the last time we had something that looked like a breather in this market, believe it or not. It's right here. Okay. So again, not the end of the world by no means, right? You could hardly even call that selling. But you had a little bit of consolidation here. Okay. Once hedge funds were forced to not only cover shorts, but scramble and put on long exposure. Okay. What happened after that was pretty important as well. Because right after that, when the market started to digest its gains a bit, you can see what they did. They went right back to the short side again, right? Where they didn't have to do that. They could have obviously added to their long exposure, thinking that the rally had legs, right? The bull move had legs. They did not do that. They did the opposite and they added to shorts. Here's the zero line. Okay. That forced them, obviously, they're behind the eight ball again, this move now. And so what we've been looking for here is now something similar to this, right? Similar to that event where they flip over to the long side because they've covered the bulk of their shorts here. They're at pretty much neutral, net zero line right there. And we're looking for them to scramble and add some long exposure. Okay. What happens after they do that will offer up some good and valuable information, right? But we'll cross that bridge when we get to it. The first thing we're looking for here is for them to get involved on the long side. And at that point, right, you might see some sort of digestion and breather just based off, there doesn't have to be a catalyst, just based off the buying and selling itself, right? Where buyers kind of exhaust themselves in a sense. Okay, so that's what we're looking at. And again, if you've been on this webinar, we look at this every week. There's no new information here. If there's any information, there's still net short. And we were talking about in the steam room, and we'll get to that after this, after we go through some of these things. I'm convinced we saw a lot of the chasing and buying in the options market today via the call buying. There was some really nice size order flow in a lot of cyclical names, a lot of names that have been lagging the growth tech AI theme, right? Some of those cyclical semis that we were just referring to. So I think, based off seeing how the flow looks like when these guys do dip their beak and get involved, I think we're at least starting to see the signs of them putting on some positions in other things in the equity market. Okay. So we'll see, right? We'll see. We should see a spike or even a gradual increase in this indicator as we continue to see more of that. The other thing we wanted to pay attention to was in the futures market, right? And again, there, similar thing. We're looking at how money is positioned. You got hedge funds that are still net short futures, right? Specifically S&P 500 futures, but futures as a whole, they are net short. Okay, so they are net short as a whole in individual names, and they are net short as a whole via futures. Okay, for me to make the argument that all the buying is done, right? In all likelihood, you would have to see these guys get long, right? The market has a tendency of forcing big crowds to get long when they're behind the curve, right? When they're behind the eight ball. So in the futures market, we're seeing very similar that we're seeing in individual names. They are still short futures, S&P 500 futures, and we will likely see them get long before it's all said and done. Sharpies, commercial hedgers, which a lot of times will take the other side of that trade and have been taking the other side of that hedge fund crowding trade for the last few years. This is what you're looking at here, right? So this is Sharpie, as we refer to them, Sharpie net positioning in index futures combined, right? Equity index futures. They are slightly long, okay? And you're probably looking at this and saying, big deal, they're slightly long. Commercial hedgers are rarely ever long, net long, in a market that looks like what we're seeing today, rallying as such. Okay? They are notoriously known for slapping hedges on as a rally extends. Why? Because there's more participation, right? Not less. As a market extends its rally, sentiment becomes more bullish, right? More bullish positioning as a market extends, and that's when they look to slap on hedges and take the other side of that trade. Example, late 2021, right? After the summer of 2021, you could see how aggressive they got adding hedges as the market continued to move higher. Okay? So this is unusual for this crowd to be net long in a market that looks as such. And the reason why they are, in my opinion, is because hedge funds are still net short. So once we see hedge funds capitulate and flip to the long side, that's when you're likely going to see Sharpies start to slap on hedges. Right? So the more long they get, hedge funds I'm referring to, in all likelihood, the more aggressive commercial hedges would be in hedging their positions. Okay. So again, these are some of the big picture positioning things we like to look at backdrop wise. Okay. It's not going to determine whether the market goes up or down tomorrow or the next day, right? This is just, it gives us a good feel of risk on, risk off, and whether we should look towards dips and pullbacks as an opportunity to get long, or we should be a lot more cautious, right? And as of now, again, same thing we've been looking at for quite a while now. We're seeing the same signals here. We're seeing the same signals, right? So, and logically, another way of looking at this, even if we want to blow the picture out even bigger in a sense, right? If commercial hedges, if Sharpies were concerned about a bubble bursting per se, right, in the near term, wouldn't they be at the least hedged, if not aggressively hedged, into the highs of what we're seeing right now, into the hype of Nvidia and everything else, into a replay of what some people are calling 1999 bubble, right? You would think if they were concerned about something like that, or even early on in that process, they are likely to be hedged, right? And they are still net long. So they are not concerned about it. Doesn't mean somebody can't fire a nuke and it lands, God forbid, in the wrong place, right? But for the information that's at hand right now, they're showing no concern about anything being too bubblicious out there and creating a major problem, right? So again, we look at this every day, week every week, and reevaluate according to what we see in front of us. We're not trying to predict too much out here. These are the credit markets, right? The credit markets, for what we look at, have been telling us that not only is there not a problem out there, right, in regards to the banking system or in regards to on a company individual basis, it's been telling us actually the complete opposite, right? Kind of almost signaling there's some sort of Fed put at play off those October lows. Okay, all the risk, everything everybody was worried about as far as in the credit markets got completely sucked out off those October lows last year. For whatever reason, Yellen pivoting, Powell pivoting, this thing, who knows, right? That's above my pay grade. But the credit market signals we pay attention to have all been screaming the same thing, that whatever was a concern prior to October was no longer a concern and has evaporated out of the credit markets. Okay? And you can see they continue to play the same song. All right? There will be a time when that aforementioned correction I keep talking about will show its face. It will happen. It's the inevitable. It's just a matter of when. Okay? If there is some sort of headline or news behind it, we're likely going to see some of these credit market signals start to react. All right. I think that's the next stage where we need to pay attention to these things a lot more closely again. They will signal to us whether it's just a normal correction and we should be looking for long opportunities, especially in some of these new leaders we're starting to see and stuff like that. Or we need to be more cautious and allow things to play out because the credit markets are showing more concern. Okay, but until we get to that point, right now, as you can see here, there's not a thing they are worried about. Okay, not a thing they are worried about. And same thing goes for credit spreads. You hear a lot of people talking about them, corporate spreads, high yield spreads. SocGen here making the point that it's been pretty bullish there, and they're the tightest spreads are the tightest we've seen in the past decade, which is kind of ridiculous considering what the Fed has done, and some of the what we've seen out of the regional banking sector and stuff like that. You wouldn't think that we'd be seeing this much risk being priced out of the credit markets, right? But there's obviously there's more to it. There's something more to it here. I see people, I see the liquidity bros battling it out on FinTwit, whether the Fed is injecting liquidity or is not doing QT, is doing QT. Everybody has valid points, but for me, regardless of who's right in their argument, the markets themselves are telling us that they're doing something, right? They're doing something. This risk appetite we've seen come alive, right? At certain points when we see an injection of liquidity or a bump up in Fed reserves or whatever it may be, it's no coincidence. It's no coincidence. When liquidity is being drained from the system, nobody has an interest, it seems, in AI, in shit coins, in Bitcoins, and all this stuff. Nobody cares, right? Can't find a buyer anywhere. And then all of a sudden, right, a little shuffling around from the Fed or Yellen in regards to treasury supply, and all of a sudden these stories catch fire. So that's why they're important to pay attention to. And again, not for buy-sell signals, for risk-on, risk-off signals, and to guide us in the right direction off pullbacks and weakness. Something else that's interesting I've been looking at here recently, it looks like retail has even started to sell. So retail got involved last year in a meaningful way. They seemed pretty excited, but this year they've slowed down. Again, depending on whose information, what house's information you're going off of. But the stuff that I follow, this one, JP Morgan, also Goldman was showing something similar. Retail has really calmed down of recent. Okay. Now, there could be a few reasons why. They were big Mag 7 fans, right? A lot of the money they were positioned at that time when they were excited was in Mag 7 names. You got Nvidia still doing its thing, but you got Apple and Tesla that have look like dog shit, right? So as these names have lagged, right, quietly, all of a sudden Apple, you would think it would be made into a bigger deal if Apple and Tesla were going in the opposite direction of an AI-driven meltup. Can you imagine I told you that in, let's say, September of last year? What if I told you there was going to be a meltup, AI-themed back meltup? And I got news for you. Apple and Tesla not only aren't going to participate in that meltup, they're going to go south. You would think I was nuts. No? Who would have predicted that? Who would have positioned for that? Nobody. And whether they admit it or not, you know, I remember Tesla back when AI was heating up last summer, right, coming off the SIVB disaster. People were preaching to me, and they had good reason. I'm not saying they're wrong, but they gave me the whole script that Tesla is the biggest AI play out there. So it just goes to show you how tricky this market could be. And not only that, I think it goes back to the point we've been making for a while. All of us, you guys, even more than me. It's been a market where you've been a lot better to react to than try to predict and anticipate, right? Because a lot of this stuff, if you try to predict it, even being right, you could have been wrong when it comes down to making money. So really interesting. So you have Apple and Tesla lagging and going in the other direction, and retail flows, right, in individual names. That's that light gray line right here, that light gray. Right, you see them coming out of some stuff. Pretty interesting. So net, we got a market where, again, the information in front of us, you got the credit markets basically signaling there's some sort of Fed put at play, right? That the credit market signaling that the Fed and Treasury is likely going to allow the economy to run hot, allow inflation to run a little bit hot if it so chooses, and all the risk out of the credit markets has been completely sucked out accordingly. And at the same time, you have on the pro side, the hedge fund community, which hasn't believed in the rally, still not believing in it. They're still net short. And keep in mind, in regards to the hedge funds, remember what they were buying, even when they were getting long. Remember those charts I showed you over and over on the morning broadcast with the Mag 7, right? Remember what that Mag 7 positioning looked like? Well, I'll get you an updated version because it's obviously come off those highs. But that's solely where all the money was. They were long Mag 7 names and literally short almost everything else. Even tech, they weren't even long tech as a whole outside of those Mag 7 names. You know? So we have a scenario here where the hedge fund community still hasn't took the bait on a long side, and retail has second guessed it this year as well. So how does that shake out? You know, in simple English, again, even if you don't, the melt up thing gets. I don't want to be like everybody else out there. That melt up word gets thrown around way too loose. You hear it everywhere, right? Every time the market rallies, melt up, melt up, melt. Maybe this is the one time we get a true melt up. Okay, but based off positioning and what we're seeing, right, the credit signals and everything else, what that tells us is that these pullbacks, these dips, will likely be shallow. Right? Because you have money on the sidelines that wants a pullback. They need a pullback. They need to get in. Okay? And unless there's something out there that enters the picture, that rains on the parade, changes that narrative, right? That spooks them away from needing to get in, you know, you'll likely see that type of price action until we see this positioning adjust and shake out. And it will. We've seen it before. It will. Just again, you can't predict it. Sometimes it takes longer than others. You know, sometimes it takes longer than others. So that's where we stand. Brotherly love, I appreciate it, TD. Anybody have any questions? And we'll get to names because I think that's always the most exciting part about a bullish market at times, especially when you have names involved. But anybody have any questions? You're suggesting this. I can't see that. These emojis always get in my way. Hold on. this likely ends in a blow off. Yeah. Again, what's your definition of blow off? I don't know. Blow off doesn't necessarily have to be a blow off. All right. It doesn't have to end in a blow off rally. The point I'm trying to make is that without something new, okay, without something, some sort of shock, something unexpected that enters the picture, okay, you have a large crowd of money on the sidelines that not only wants to get in, but because of the performance needs to get in, right? And without that narrative shift, every little dip, every little fade you see, they're going to look to buy, right? And what we're starting to see now, especially, we're starting to really see, like, think of this, right? The perma bears, okay, and they have a reputation for doing this, but the perma bears would have you to believe that it's just been Nvidia carrying this market higher the whole way, all right? And the truth of the matter is, it was like that prior to October. Okay, prior to the October lows, it was a really thin market. Mag 7 was carrying the weight. Mag 7 got extremely crowded because of it. But since those October lows, that turn off the October lows, the QRA, right? When that Yellen pivot, we've seen a different character in this market, right? It went from the Metas and the Nvidias and the mega cap names to now, right? You had a broadening out in the chip space, in the semis, okay? And then not only the large cap semis, you started to see even some of the mid cap semis, right? We started to see some underbelly growth names that we were talking about. You started to see a name like SMCI hatch and explode. Okay. So beyond that, I could keep going. And then we would hear it was just tech, right? I mean, does anybody look at any of the other sectors out there? I mean, you got banks that have been up in a straight line. You got housing related stocks that are up in a straight line. You got biotechs, you got pharma names, you got healthcare names, you have industrial names, you have engineering and construction type names. I think the problem that forget about the perma bears. The perma bears are always going to find that one line to throw at you to make you feel miserable and bearish, right? But I think even the skittish bulls, right? The problem has been that it's been a large cap driven rally, right? The biggest winners, the best performers are all in big, large, expensive price names, $800, $900 stocks. Okay. Now we've seen that even now that today, up to today, we've seen that broaden out, obviously, right? We've been talking about a lot of the other names that aren't $800, $900 that have been strong and rallying hard. Okay. But I think that's what kind of was almost frustrating, and including myself. If you're not a call buyer, right? If you don't buy calls to take advantage on the long side, it was difficult to get involved in any aggressive way, right? I want to know how many of you out there and how many times you would have played it would play a name like this if you couldn't buy calls and you had to play the equity, right? So that was the problem. It wasn't that the rally was thin from the October lows to now. It's that a lot of the larger cap, the more expensive price names, not expensive in value, just highly priced names, were the best performers. So I think that was the tricky part. Okay. But we've seen that change. Now we're seeing we've seen it broaden out, we've seen it spill over. Eventually, it's going to spill over into enough people are going to get long, okay? And we're likely going to run into some sort of correction. If you do get the blow off top, Alan, that you're talking about, where everybody gets in and the market continues and goes on some parabolic quote unquote melt up, that's going to end in a bad way. It always does, right? It always does. When everybody's in and when it comes to time that everybody needs to sell at once, it gets pretty violent, you know? So to answer your question, Alan, I have no idea. I have no idea how it ends. You know what I mean? If I knew how this ends, I wouldn't be here talking to you on a webinar. I mean, come on, let's be honest. I have no idea. Right? What we like to do is we like to look at certain things, certain signals that we have some confidence in that gives us a little probability and edge, and that's it, right? And that's it. But I have no idea how this thing ends. You know, look at the 90s, okay? If we're in the early to mid 90s, okay, we're going to run into a correction. It's going to feel like the end. And the truth of the matter is, it could be just the start of a bull market. This could be just a start. We have no idea, right? But you want to use the late 90s comparison into 2000? It could be the end, right? So nobody knows. Nobody knows until you're there, until you get through it. Well, nobody knows. Feels like Tesla 2021, except much more aggressive. That's a good point. All right, that's a good point. You know, I think, listen, the bulls, I think the real bulls, Alan, at heart, like myself, like I get thrown into the perma bull category a lot. But those of you know me, I guess I am a perma bull though, right? But I go from perma bull to cautious bull. You know, I'm not a stupefied bull that I just say buy everything at any price and it's going to keep going higher, right? But I lean solely bullish, right? When I'm not bullish, I'm just more cautious and conservative. But I'm always looking for the excuse to be bullish because it just doesn't pay to be bearish, right? But I'm not getting into that rant, okay? Even if you try, I'm not getting into that rant again. The point of the story is that even bulls at heart like myself are looking forward to when this thing does go into some sort of digestion phase or some sort of quote unquote end. Because that's how we're going to know what this really is, whether it's the start or, like you're saying, the blow off top. You know, that's how we're going to know. Right? My feeling is the longer this goes without a correction, okay, the higher the odds of some sort of blow off top, like you're saying, Alan, that can end pretty. It's going to have a bad ending. It's going to have a really bad ending. Okay, if you have that blow off top, like for example, if we get a correction or some sort of 2-3 month digestive period, okay, the sooner the better here. That would be the most constructive thing that you could ask for, right? Because you know that the bears are going to think it's completely over with. You know that that's going to shake out bulls, right? And that would be more fuel for that next push higher, right? But without that, all we're doing is dragging in more bulls, right? All we're doing is adding more bulls to the crowd the longer we go without that correction. And the more bulls, more bears you convert into bulls and you drag into the crowd, right? The worse it gets when that time comes. So that's the problem. But I think, listen, on the short side, and I hate talking anybody out of a trade ever, okay? But again, there's no way of knowing. You always battle this risk. Anything can happen at any point in time in this game, right? You don't know what could happen tomorrow, right? Something that is unexpected. But the last thing you want to do as a player in this game is short into this. It's just it makes zero sense. It makes zero sense to me. Zero. Okay? And if you make money, I think it's the worst thing that could happen to you because you're going to do it again. You know? And I know the majority of you play puts, and I think that's good. Okay? If you are going to bet against the market, I rather see you do it via puts than getting short equity. Okay? So that's a good thing anyway. But the damage playing the bear side in this type of tape, the damage that it does to your psyche, even trying to be bullish, it's hard to be bullish when you have that bearish bias. So not only are you likely going to lose money, but even if you break even on the bearish side, you're missing out on the opportunity on the bullish side. You know what I mean? There's no logical reason or explanation that you can give me to try to short into this type of market like this. Okay? It's the toughest thing to do. If and you don't feel uneasy about what's going on around you, I get it. You think there's some signs that things are bubblicious out there, NFTs going for this, Bitcoin going for that. I get it. Okay? But you can take a more conservative approach and still participate and try to make money if you're uneasy. Doesn't mean you have to be bearish. You know? Stay in a high cash position. Right? There are other things you can do besides trying to catch a top. But that's the most difficult thing. I'm not even saying you, Alan. I'm just talking about in general. I know, you know what I mean. I know the majority of you are already well aware of that. I'm just saying in general. You know, if you're in a high cash position and you're treading, you're playing lightly because you feel uneasy. Worst comes to worst, you're just not making as much money as on the long side as if you were aggressive, right? You're not going to get hurt. Okay. Much better than shorting and getting your head ripped off right now. But the truth is, to answer your question honestly, Alan, I think it's nobody really knows. It's a matter of, does the market force everybody into the pool? Okay, where the true definition of there are no more buyers left, that's what happens. Just like in bottoms are a little bit easier than tops. But when a market bottoms off a correction or a bear market, usually everyone's bearish, everybody's already hedged, everybody already sold, and there are no more sellers left, right? Only you have shorts, and when you start running or squeezing those shorts over, that's it, okay? And tops are very similar, but they're more of a lengthier process. Okay, because once you have buyers, everybody's in the pool, everybody's long and just holding on for the ride. The littlest thing can set off a sell-off, right? Can set off some profit taking. So, but we're not at that point yet. We're not at that point yet. So the point I'm making is we either get something like that, or we get something that enters the picture, a surprise. Okay, and that can totally happen. It's totally normal, right? Something that we don't see in front of us, something we're not aware of, pops up, gets people spooked, starts getting people to scramble and put on some volatility and hedge exposure, right? Because nobody has a lot of that on right now. Prevents, puts dip buying in the back pocket because they're skittish. And that shock can obviously rattle the cage enough till you get some sort of sell-off. But when does it come? How are we going to predict that? Do you know anybody who can predict it? I don't. I have no idea. But what we see on a daily basis in front of us right now, a little hotter expected CPI, that's not going to cut it, right? Rate cuts, we're not going to get as many as the market wanted. That was supposed to be a problem, right? Obviously, that's not a problem. It's not about that right now. It's about, again, just think of it logically, right? You got an AI story that, if there's liquidity, is a sexy story, okay? And you got a narrative out there in an election year. The Fed and the government, right, fiscally, are looking to run things hot, right? Biden wants the economy propped up, looking good to get reelected. Powell don't want to get in the way of that. He don't want to rain on that parade, right? He don't want to be blamed for any election loss. So he wants to take a step back and kind of do nothing, ideally, this year. So he allows the economy, the market, and inflation to run a little bit hot. That's a good recipe for stocks. That's the narrative out there right now. Eventually, things may have been rallying too much. They get too overpriced to where that kind of gets priced in. But how could you say that's priced in now? You got stocks that are just starting to get involved, right? Over the last few weeks. So we'll see. Again, we'll see. The most we could do is, here's all right. We look at the flow every day. So we got real-time gauges on things, right? We evaluate the stuff. We look at the stuff and the information in front of us every day. We see something that concerns us, we take some precaution. That's the most we can do. That's the most we can do. All right, so let's talk about a few names here. Here are a couple of these cyclical semis. We started to see signs they were going to come after these things, right? We talked about them on the last couple of webinars. What the hell is this? Coffee? I got coffee stains all over my desk. You got names like this, right? We started to see Micron, right? Western Digital. These are the names we were talking about recently. Taiwan Semi. What am I doing? I'm lagging. Marvell, which had earnings. Okay. We started to see interest come into these names. Okay. As opposed to just the NVIDIAs of the world and AMD and stuff like that. Little by little, they were starting to gravitate towards these more cyclical semiconductors that really have had a tough time. They've been stuck in consolidation for a long, long time, right? And one by one, we're starting to see flow, and they're starting to act better. And today, they really came after them, right? So this NXPI caught some action. This thing broke out to new highs recently, right? After a huge consolidation. Like, look. And we saw multiple sweeps today. I should post the action so you guys can see what the hell I'm talking about, right? Hold on a second. We'll look over some of these orders because they were pretty decent looking. Bear with me here. Oh. Okay. I hope we could read this. And maybe you guys saw some action or are looking at a few names that we weren't today. Let's see. I gotta take 3 screenshots today of this. And for those Steamroom members, I'll update the list and post it, the top bet list, once we get off the webinar. And they'll be in market updates, as it always is. All right. So here's some of the action today. Let's look at some of these names. Microchip. Anybody in this know about it? Like it? Looking at it? Hoping for a dip in it? Anybody out there know the name? So again, this goes into these, I call them cyclical semis. But you can see they look obviously a lot different than your NVIDIA's AMDs, right? A lot choppier, just consolidation. And they're known to do this, right? they are known to go into these consolidative periods. This one might have been a little longer than usual, but when they come out, they love to rip. See, rip, consolidation, and possibly coming out here, rip. All right, so here's Microchip, had a big day today. All right, again, ideally, you would like to see these things. Here's my problem. I'm old school, right? Let me get in my rocking chair for a second here and talk to you young folks. Back in the day, back in the day, you wouldn't. I basically molded myself not to chase, right? So I would look on a day like today, right? If you weren't in this thing already, okay, I would wait for it to consolidate, right? Possibly shake out, breathe for a little bit, and that would offer up an entry. Okay. Now with the machines and all the crowding positioning out there, you see a lot less of that. Especially this rally, we've seen hardly any of that. Right? Once these things get going, you get a breather for a day or two, you're lucky. Okay. So again, to each their own, that's been a fault of mine here. Like it's hurt me throughout this rally, is waiting for better spots on a lot of these things where the market just doesn't give it to you. But look at the action here. Here's the action. Jan 135s, November 115s. So you have some time. Okay, you have some time there to fool around a little bit for a better entry if you're not in it already. NXPI, this already hit a top bet list we threw out there about a week ago, I think it was, maybe more than that. NXPI, we just looked at this name. Here's your consolidation, right? Busting out to new highs. And same thing here. Some of you youngsters may not know this name. This thing's a beast. This is no riffraff semiconductor. Right, here's off the COVID lows, that rip. Right? Here, pre-COVID. And even, every semiconductor rally, this is usually a leader. This has been one of the few where it hasn't. Okay, and what they bought there today with some time again, May 270s. You see these type of orders I'm showing you here? Not weeklies, right? They're not buying out of the money calls for 30 cents. This is fund positioning. This is the way the funds like to position in the options market. That's why I think today was one of the first real signs we saw from recently, especially, of that long only fund crowd starting to get involved, or hedge funds in general, I should say. Okay, so those are two cyclical semis. If you're sick and tired of semiconductors, there are a few names here that aren't. PRGO. This had a nice rip today off the action. Now this is a little different. This is medical related name, correct? And this is a stock in a downtrend, right? Horrible downtrend. And there was some insider buying recently into the lows here. Okay, you had some action, a little action yesterday, a little bit more today. So somebody thinks the selling has been overdone. Nice size bet. And like I said, some action yesterday. Here are some of these commodity cyclical related names that have really struggled. Okay, I wouldn't say struggled, but really had a tough time finding any upside follow through momentum. This is Southern Copper name. Now again, looks nothing like these names you may consider overextended or bubblicious or whatever you want to call them, right? And these are different type of names, okay? So you may get some of these breathers to play off of. So again, you don't necessarily, even if you're more tactical here, I think that's the beauty of what we've been involved in this bullish trend here is that even on a tactical basis, right? Names that are seeing action, a lot of these names continue to see action. You don't have to build a size position and sit in them. If you're uncomfortable with the overall market, we're due for a correction, we're due for a pullback. You understand? You don't have to just sit. You can look to play these things off pullbacks, off little sell-offs. And especially some of these in the cyclical camp, because they do see their share of selling. Okay, so this is a name to definitely keep an eye on off dips. Copper name, if you're interested. Again, fundamentals are there on the majority of these names. All the names, the majority of the good looking flow we're seeing is all in profitable companies, and a lot of these companies are growing their profits at a pretty impressive clip. All right, FCX also had some flow today. You could see how choppy that has been. ARM, you guys know that stock well, right? Quite a okay looking. We've seen bigger in ARM. July bet. Okay, this had that big move, and now you're getting a breather here, right? So you got a bet there, 500 lot, $500,000 July with some time, 240s. The best looking action in ARM that we've seen has all been with time. As a matter of fact, as you guys know, we were talking about this name prior to earnings. Here, they absolutely bombarded Jan 2026 calls. Bombarded, tattooed. Okay, so we've seen them roll some of that stuff up here, right? But this is the problem with some of these hotter names is that we saw the initial buying occur here, and that's at $70, and now 100% higher. You're looking for an entry. At least you got some consolidation here, right? But again, could be traded, right? You could just look to trade this thing. You don't need to buy and sit and hope it hatches if you feel uneasy about the market. Okay? You see this thing dips often, right? Especially if you see flow return, and a lot of the flow returns in these names, right? You can trade this thing. You can actively trade this name if you like it. Here's another one. I traded this one today. ON. I like the spot even more than the action, and the action was pretty exceptional. But you could see same theme, right? A whole lot of nothing, and this is a good company, right? You had this big move. You had some consolidation along the way, but this doesn't look too out of the ordinary as far as consolidation. And right here at a pretty decent risk reward spot. And the reason I say that is, this thing hasn't been running for 2 straight weeks. Right? You had a rally off earnings, some digestion, and then before this candle even looked like this, they started buying pretty aggressively, and you got some cushion. Like this thing had a really nice run today. I mean, the whole morning, these things went up in a straight line and didn't stop. All right? Look at this. This is a 5-minute. Boop, 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 boop. Right? And then kind of just died out here. And there were even more sweeps. I probably got to add here different lines. But September 100s, October 100s, they've hit them a few times. A lot more than just these two, I'll tell you that much. All right. So again, Steamroom members, if anything, any better looking sweeps on there, I'll add them. AOS, I think those of you on the morning broadcast probably saw this one get swept. We've been seeing a lot of action in these type of names. Okay. Now the problem with the options in these names are they're thin. Okay, they don't have a ton of open interest. They don't catch a lot of flow. But They've been buying these things. All right. Here's another name. I'm not too familiar with it. A.O. Smith breaking out. All right. Why am I so laggy on here? Breaking out. And you pull up their numbers, $1 billion for the quarter, a dollar a share almost in earnings. You do have earnings in April, end of April. But these are the type of names. So many of these type of names, so many that have been doing exceptional. CDNS, you guys may know this guy. We saw some recent put selling in this stock, and now some more call buying. This thing's a stud. Look at this. My goodness. All right. Good looking numbers, good looking growth. Again, this has been going up for a while now. It's been a hot name. But what we've seen with a lot of these names is when you get this little breather, right? These little breathers, they like to attack them. They'll sell puts or they'll sweep calls. We saw it in a couple of these. ASML. Right? Same thing. There's the circle right there. Right? They do some buying in here after a little breather and bink. ADI, another cyclical semi. Same thing. All right? These stocks really haven't gone anywhere too far yet. All right? So if the buying is just starting up in these things, there's money to be made. There's money to be made. You know, these are good companies. ADI reported $1.73 this past quarter on $2.5 billion in revenue. No hype job. Legit name. QCOM, they have lit this thing up this week. Okay? And now QCOM fit that bill. But now that egg has started to hatch. Right? So QCOM, same theme, right? Trouble, choppy. We've been seeing really aggressive buying, especially with some time. September calls started up maybe a couple weeks ago. Right? They really started to heat up. Today, it just exploded. And now look at this move. Right? And you guys know this stock. This is no jabroni. $275 in earnings, $9 billion for the quarter. She's a monster. STM, this is I think an overseas chip name. But same thing. Looking to come out of consolidation. This is an ADR. I got one more page of this, I think. Yep. And this guy, you know this guy. Texas Instruments. Look. This is still in consolidation, right? Still in consolidation. And again, beast when it gets out. Beast. Why am I so laggy? All right, you get these lengthy consolidations, and if they ever get out and participate, they usually do it in a meaningful way. Now, again, maybe these names don't go parabolic from here, right? Maybe they rally, okay? Maybe they form a right side of an uptrend on the chart. Maybe possibly we get some sort of breather or correction in the market, okay? Even more so then, we get, if and when that pullback arises, that's where we really want to pay attention to all these things that are catching action, because a lot of these newer names that are getting attention are likely going to lead us out of that correction when it shows up. Okay. But so let's say, right, you're a hedge fund, you're behind the curve a little bit. Nvidia has gone parabolic. Avgo has gone parabolic. All these stocks, you can't get your hands on, they're going nuts. And you got semi chip stocks that are a little more cyclically oriented, tied to the economy, but the economy is doing okay. Right? The Fed's not getting in the way. The economy, they're letting things run hot this year. This is appealing, right? To players who need to do some catching up. And that's what I think we're starting to see. And good old Google caught some dip buying today. Here's another, by the way, Mag 7 name that's been awful considering the rally, right? Google, AI rally and not participating. So Google off this pullback, you got a downside niner, right? In simple English, exhaustion signal with an upside niner, downside niner, looking to put in a low, and May 135s. They hit these pretty good. Not just 2,000. I think it was like 12,000, more than that. Okay? So, again, you can see the list is widening out, and even, I get it, even if you're skittish because of how far we've come, you see a market that there's been no pullbacks and we just continue pushing higher off one-day dips. All right, look at this. You may not want to get too aggressive here until we do get some sort of digestive period. I get it. But you could even trade these things tactically. You could, right? On a more short-term basis. On a short-term basis. And trade these things. And like I said, the beauty of these things is that when they're down, once they start catching action, these sweepers stay committed. Because what these funds are doing, they're not going to dip their beak and then never show up again. Right? So you get a name like any of these semiconductors, even a Google, right? Let's say it's down tomorrow. Okay? They're going to look at that as an opportunity to add. Right? So these dips, they get supported. And no matter what, I think in a lot of these names, I think we continue to see that until something changes the narrative out there. All right, closed above. Oh, Google closed above the 200-day. Andrew just mentioned. So for those of you, you got again above the 200-day. And you got what I do here. God damn it. You got a downside niner there, which is always a decent risk-reward spot for a trade. And Google's only $130 compared to some of these others. See, that I tell you, that has been the biggest problem for me. And some of you don't know that about me. I'm not an options guy. I'm an equities guy. I obviously am looking at the flow all day, right, as a handicapping tool. But my whole career, I've been an equity guy first, and I trade options around equity positions. And when you got $900,000 stocks that are where all the sizzle's at, it's not ideal if you're an equities player, right? If you're an options player, it's perfect. You'd rather that than believe it or not, the better trades I've had have been in cheaper stocks, and there's not a lot of them. Like I played, this one has been good for me recently, HPE, right? You guys probably aren't even looking at this thing. You couldn't care if you're trading options. You probably couldn't give two shits about HPE. Let's be honest. All right, but look at the move, equity wise, 14 to 20 in a straight line, pink, pink, pink. Right, you guys know that I played that cart. I like that cart. All right, $20 stock from here to here. Um, I played this one, AMKR. I still got some of that. So those are the type of names that I do well with. More underbelly. Again, they don't have to be single digits, but if they're 800, $900, I'm I'm not getting too crazy on the equity side. Am I tempted? Where, Andrew? Am I? I can't see the end of your sentence there because am I tempted to buy options? You're saying? Yeah, of course I'm tempted. Of course I'm tempted. But see, for me, like if I'm going to trade options in these things, which I still should have done, obviously in hindsight, but if I'm going to trade options in these higher flyers, I'm not going to size up. I'm not going to size up in them. So I'm going to take smaller shots. But I mean, knowing what I know now, the way some of these things moved, it would have been worth it. Now, would I have held for those moves? Probably not. You know what I mean? Yeah, the returns are nuts. The returns are nuts. It's a comfort thing, Andrew, for me. And at this stage in my career, it's hard to explain to you guys. Unless you've been in the game and then you can relate, or even if you're not doing the same thing, you could understand. It's more about controlling my risk, right? So I think like options, the best thing about options, I think, is that how you can manage your risk so effectively. You can literally, there's nothing better. You can put in an option what you're willing to lose, and that's your stop loss, right? There's no better way to manage risk. Worst, even if the stock crashes, goes to zero, you're only going to lose what you put into those calls. Okay. But to do that, you got to feel the risk reward is worth it, right? If your stop loss is zero on those calls, the upside that you're looking for has got to be at least that, if not more. So again, knowing that what I know now, the way some of these things move, it's obvious that it was well worth it. But rewind before these things started really getting hot the way they have, I just, I feel more comfortable, buying some decent size of a cart. And, if it doesn't move over the short term, I can stop myself out and move on, right? Like, for example, if I buy equity in an ASML, normal price action, that thing could be down $30. You know what I mean? And nothing's wrong with it. Yeah, I agree with you. See, and so you know what I'm talking about. You know what I'm talking about. Options, you don't. If you're going to try to utilize a stop loss, you're going to learn the hard way. You don't have as much control over that, and especially like some of these names like MSTR, where the spreads are crazy, right? Between the bid and the offer, you're down 50% on some of these things. You understand? So you have less control unless you're putting in, you're risking your premium, or a big chunk of your premium, like is Watto saying. So again, it's a comfort thing. It's a risk tolerance thing. Again, if rewind 20 years ago, I'm slinging calls a lot more aggressively. Even equity, I'm slinging a lot more aggressively than I am now. But now at this stage of my life and career, risk is everything. Like the first thing I look at is, all right, what am I risking? Do I want to risk that? And, or do I look for something else where obviously the reward may not be as fruitful, but I can control my risk? Yeah, well, Max, before you get married, before you have a kid, and before you break, I would say 40 years old, you know? So for those of you in your 20s, or I mean, Jesus Christ, I wish. That's what I'm saying. You guys don't. There's no reason. I get it, the YOLO and all that shit, but you guys don't know the luxury of being young in this game. The advantage you got. You don't know it. You don't know it. All you got to do is hang around, avoid blowing up your account, and you're gonna be wealthy no matter what. I hate to break it to you. You're gonna be wealthy no matter what. But when you the YOLO, that to roll the dice, that philosophy of rolling the dice and options, the problem is not doing it once or twice. You understand? You get lucky, you can make a score in this market, you could do it 3, 4 times and make a bundle of money. It's the habit. The you're forming a habit that's going to be hard to break when you need to, where it needs to be broken. Otherwise, you're going to lump yourself up. Right? It's the same mentality that I try to stress to you guys with playing the short side. It's not about, you can't make money on the short side. Of course, anybody can have a couple profitable trades on the short side. It's not. I'm not saying that is impossible. Of course, that's not what I'm saying. What I'm saying is what it does to you emotionally, psychologically. It can become a major problem. Okay, maybe you're wired differently. Maybe you're in that small group of people that are wired differently and can play both sides. I don't know a lot of those people. You know, I don't know a lot of those people. Very few. And the ones I know will tell you that same thing that I say, they lean bullish, but when they get into these bearish environments, that's when they'll dabble on the short side. And when they need to, they can flip right bullish and get rid of that bias completely. That's not an easy thing to do. It's not an easy thing to do. And if you're not honest with yourself, you're not fooling anybody in this game. You understand? You're going to learn the hard way. So I knew early on in my career that there was no way that I can go long, flip short, go long, flip short, go long. There was no way. No way. So I came to the conclusion that it was the few times that I would go short, the few times that I would make money going short wasn't worth the damage it would do to me on the long side. It just wasn't worth it. And even the majority of players I know in this game, they'll be the first to admit it. Well, how'd you do this year? Well, if I took out my short book, if I got rid of all my short trades, I would have had a great year this year. You know what I mean? They all say the same thing. They all say the same thing. It's not an easy thing to do. Not an easy thing to do. Yeah, and this market, and that's the other thing too, right? That's the other thing that really it made me feel like a sucker playing the short side. Because I came to the conclusion, and you all should do the same, this market is rigged. This is not, let's be honest, this is not a free market. Don't listen to any bullshit out there people are feeding you. This is not a free market system. If it was a free market system, all these banks would go poof, they'd go under. 2008 would have looked like the apocalypse because not only Lehman, but everybody else would have went under. Okay? This is a rigged system, right? It's a rigged system. And kind of like what we're seeing now. Let's be honest. We had a Fed that told us higher for longer, economy be damned, stock market be damned. We got to wipe out inflation completely to where we don't even see it's not a threat anymore. Completely. Okay? Before we even start thinking about to get away from tightening and draining liquidity. Okay, higher for longer. Not only did they flip flop on that, but they're talking about cutting rates, right? Cutting rates into a market where pockets have gone parabolic, where there hasn't even been a crack in the economy visible to us yet. So I have no problems with it. You want to rig the game? Rig the game. But I'm not going to take the other side. That's for shit sure. It's like that story I tell you guys about my boy who played online blackjack. He got buried playing online blackjack. The bookie, right? Back then it was bookmakers before DraftKings and all that. The bookie, who I was friendly with, came up to me and goes, listen to me. I got to talk to your boy over there. The blackjack game is rigged. He can't make money with that game. We got to tell him stop playing it. He told them the game is rigged. Don't play it anymore. He stopped playing it for 2 days. That weekend, he lost 50 grand playing rigged online blackjack. I mean, what? Right? So you feel like a sucker. And listen, sometimes for the first time in my career, we saw it rigged on the other side. 2022, right? The Fed had to rig the game to the downside to battle inflation. You can't get long into that, right? We talked about it throughout that whole entire downturn, right? There's no, how could you get long knowing that the Fed was going to do what they did, and all these things we were looking at were screaming, listen, their risk assets are out of favor here. You don't get long here. You sell every rip. Right? Now that's changed. Right? So things like this that we look at, they don't tell you what to get long, how long to get long it, or buy sell signals or target prices. But simply put, if you want a perfect answer of how these things can be helpful and provide an edge in this game, in 2022, this told us, right, to not play the long side. And since literally the October lows in 2022, this told us any opportunities we were looking in the market to look on the long side. Plain and simple. Plain and simple. Again, doesn't mean you're not going to have a losing trade, or that's the inevitable. You can't avoid that. That's impossible. You're chasing unicorns if you're looking for that. But just simply stay away from long, right? Or if you're looking to short, that was the time to do it. And lean long. So that's the story, my friends. That's the story. In a nutshell, it pretty much is the same story we've been talking about for a while. As a whole, even as this market pockets have looked a little bubblicious here, it actually has become more constructive. And kind of, it's like I'm wasting my breath if and when we do get some sort of digestion, whenever that shows up, that's going to be a good thing. My fear, like I've been telling you guys, my fear is that we don't get this digestion. That when that pullback comes, it's going to be when the music stops, and it's going to be uglier than just your run-of-the-mill correction. That's my fear. I hope I'm wrong. Because again, I would, and this is what worries me. I would love a pullback here. Usually when people like me, when we want a pullback, it never comes, right? It never shows up. The market doesn't give you what you want. That's the issue. But in the meantime, again, even if you want to take a conservative approach, be a little more nimble, there's stuff to keep busy trading. Just be smart about it. Again, lean long, look for opportunities. You think the semis are a little too hot? There's a lot of other places to look right now. I had a few of you guys have been knocking the cover off the ball in some of these underbelly biotech names, the scores you made on some of these names, VKTX. So you guys know the deal here. You guys know the deal. There are other spots involved here. Other spots. All right. Anybody have any questions or anything we usually look at that I didn't show you guys that you're interested in or anything like that? Nothing. Tomorrow we have jobs off the open, right? Again, I don't think it's anything to worry about in a sense. If we do get some selling off a hotter job number, honestly, it's an opportunity. It's an opportunity. So it's something we probably want to see. I mean, hopefully, maybe we see a little tech selling off the earnings. I don't even know. What are they doing some of these things now? They might be all up now. Where does that go? Flat? Look at this thing, flat. This thing, they can't even sell this thing after this move. They can't even sell it. Unbelievable. Marvell, this one has some weakness. They'll probably buy this up. Again, look where 80. Listen, I'll tell you the truth. I didn't think you would get this nice of a push ahead of earnings. I thought they would make you sit through earnings to get this push. This was a really nice move. LSCC. There you go. That's another underbelly semi that could get going here. I like that one. Yeah, this has been moving nicely, right? Yep. No, these things didn't even get started yet. These things didn't even get started yet, Max. If these things want to get hot, they'll look hot. Trust me. Look. Okay? When this thing wants to get hot, when this thing finally attracts real buyers, that's what it looks like. All right? So the moral of the story, guys, we lean bullish, even more so off pullbacks and bad news and fades as long as we continue to see the same things we look at each and every week. Those of you who are Steamroom members, we keep tabs on it every day, right? The more new names we see in the flow, that means that the stronger the risk appetite out there. All these things we want to see will likely translate into shallower dips that find buyers. And until we see clues of that narrative changing, we got to lean bullish and look for opportunities on the bullish side. Plain and simple. Rig game, my friends. Rig game. Mobley, Stacy, interesting. Mobley, I traded. There was some short-term action last week. I think they have an investor day or something coming up, Stace, right? They got something coming up, I think. But I did trade this Mobley, caught some action, and I think it was March and April calls. Good point, Zara. I did not talk about March Expo gamma wise. We could talk about that on Thursday. That's the day before expiration. But same thing. Let's see where positioning is at going into OPEX week in the middle of the week, right? Because I think worst comes to worst, you get a little bit of selling, a little volatility off OPEX like we've seen. Those things have been the best places to find longs. So again, more of less predicting, Zyra. As much as we want to predict, this is going to be the OPEX where everything rolls over. I get it. It's a big OPEX, quarterly OPEX. I understand. But we really need to see evidence of things starting to change. Otherwise, these dips are just buyable. Okay? That will change at some point. But instead of trying to predict when that's going to happen, you want to react to it when you start to see clues of that happening. All right, but we'll talk about OPEX next week. And the other thing too with OPEX, you got a lot of March call buyers out there that are going to need to adjust those positions. So they have to replace that call buying with more call buying that may end up adding fuel to the upside. You know, the options dynamic is something playing a huge role here. You don't understand, right? Like think of like a name like an Avgo or ASML or any of these names. You got even some players out there, some funds, they're selling a piece of their equity at $1,000 a share, and they can go buy 500, 1,000 contracts on the call side, right? And the market maker's got to take that action, and he's got to hedge that action off. That adds more fuel to the upside, you know? So eventually, the longer this goes on, there's going to be that pay the piper moment, right? The longer in the tooth it gets, the more violent it's going to get on the downside. But again, when we get there, is when we'll prepare for that, right? Even if it means we lose a little money in the interim, but we could have been concerned about that all year, and think about some of the money you could have made, a missed opportunity cost on the upside. All right, but we'll chat about that next week as well. All right, have a good weekend, everybody. Again, tomorrow job numbers. Keep an eye on VIX. Maybe we get that VIX unwind that can add some fuel to the fire intraday tomorrow, and we'll talk about it in the morning broadcast anyway. Have a good night, everybody. Thanks for stopping by.